everybody, welcome to a new RRG video, recording it on Wednesday the 22nd of October. Market in the US just closed, little down day, S&P down 0.5%, nothing major yet. What I want to do in this video is maybe start a new, process or systematic way of looking at markets. And I want to do that using what I call the investment pyramid or an RRG framework to look at markets. So let me first show you the outline of the framework and explain what I want to do. And then we'll go over the RRGs and maybe some individual charts to figure out where everything is and then end up with a filled-in framework, color-coded, indicating where we feel, I feel, RRG thinks, whatever you want to make from it, the market is headed, and it should give you a good overview of the movement among asset classes, as well as sectors, commodities, and government bonds. So let me start with the basic framework. So here is the framework, and I've used this in the past on various occasions and in various different formats. I also like to call it the investment pyramid, although this doesn't really look like a pyramid because of the layout of the image. But it all comes down to the same idea. You start with a portfolio, and the first decision that you need to make is an asset class allocation. How much money are we going to allocate to the various asset classes? And I've listed the asset classes that I always use in my presentations, and which is also a predefined group on the RRG page on Stockcharts.com. So that's government bonds, corporate bonds, high yield bonds, stocks, commodities, crypto, and cash. And here are the ticker symbols that I use in my RRGs for that. So that's the first RRG we're going to look at. And that gives us an idea if something is good, bad, improving, or weakening, declining. Now in the next layer, we can dive one layer deeper. And for government bonds, that means looking at the ETFs that represent the various maturities on the yield curve. And that helps you get a gauge on what's happening in the bond market. And it also tells you what is going on with the yield curve. Is it flattening? Is it steepening? Where is it right now? And what side is it moving? Corporate bonds, I tend to stick with that high level approach. So that's LQD, same for high yield bonds. And then for stocks, obviously we have the sectors, which we all know. So look at the RRG for US sectors. And then in the commodity space, we can break it down into the GSCI commodity groups. It's agriculture, energy, metals, industrial metals, precious metals, and livestock. For crypto, I'm going to stick with the benchmark with Bitcoin. We definitely could have a next layer here. I think it's a little bit dangerous to do that with individual cryptos because it becomes a very long list. But I am looking into, I am aware, crypto indices. So I'm trying to see if we can get our hands on data for that and then maybe use crypto indices as the next layer. And then obviously we've got the US dollar index, which is representative for a cash approach. So the first RRG that we need to look at is the one for asset classes, asset allocation. So here is the first relative rotation graph, the top layer looking at the various asset classes. And as you see, here is the list of ticker symbols that we're using. I had DJP, I put it on my pyramid, but we sometimes also look at GSG. The one is more oil related than the other. That's why they sometimes can show different movements, but the correlation is actually pretty high if you look at it over a longer period of time. So let's take a look at the rotations, at the current rotations. And let me get Bitcoin out of the way because as usual, this tail is so long and that's because of the volatility and the huge moves that this thing is making. But It's very clear that it is going through a corrective period. It's moving through weakening, has just crossed into the lagging quadrant. And I'm going to label this as deteriorating. I mean, the long-term trend for Bitcoin is still very positive. So this thing could turn very rapidly. But for the time being, I'm going to put it as with an orange label on my framework. And then I'm going to take it out of the equation here so we can have a better view of all the others. So now it's fit. Now we see a little bit better what's going on. Now, the first thing is stocks, SPY. It's going through a bit of a correction, but you see that it is positioned way to the right. And that means that it is the strongest asset class, no matter what happens. Even the distance between the two, if it was closer to the 100 level on the RS ratio scale and anything else was closing in, that might have changed my opinion. But right now, SPY is the strongest asset class. It's far away from all the others, which are on the left-hand side. So this remains the strongest asset class. That also means that the other asset classes are in a different boat. So commodities, DJP, and to a lesser extent, GSG are moving into the improving quadrant, but they are still very low on the RS ratio scale. And as a matter of fact, that goes for pretty much all the asset classes on the left-hand side. So in the framework, I've also looked, or with filling in my framework, I also looked at the price charts. So I put the price charts as well to combine what we see on the RRG with the price chart. And what I noticed is that I like, for example, the commodities, and it's a little bit contradictory because corporate bonds, high yield bonds, government bonds, dollars, cash, they're all showing terrible pictures. So they're like underperformers. If you look at the long-term charts for commodities, they may have a little edge. And let me bring up these charts so you understand what I'm talking about. Here is the chart for DJP with the relative strength chart and the RRG lines. And you can see why commodities are pushing into the improving quadrant. The RS momentum line has crossed above 100. The RS ratio line has curled back up. But what's more important, on the price chart, we're seeing a market that is trying to break out of a 3-year range. And I'm taking that into account because this is a strong sign for commodities. And when that starts to accelerate, that relative strength will follow. So there's definitely a judgment call on my end, probably subjective, but what I'm trying to do is put the price action combined with the relative strength action into a systematic framework. And that's why I am a little bit more positive on commodities than I am, for example, on the bond complex. And let me quickly look at these charts as well so you can see why there is a difference. So here's the chart of GOVT, and you can see that that relative strength line is still struggling. And the price chart is threatening I call that an intermediate level of resistance, but quite soon after that, there's a pretty solid resistance level. So the combination of the price chart with the relative strength line and the RRG lines, look at how low that RS ratio line is not, at least not for me, convincing enough. And if we look at corporate bonds, that's LQD, you see a similar picture. There is a bit of room to the upside. That's probably why, that's dragging that RS momentum line higher. But we need a lot more work to get that RS ratio line, that relative trend, really up, and also to the other side of the RRG, meaning to the right-hand side of the graph, which would mean that red RS ratio line would have crossed the 100 line. And combined with this constellation on the price chart, I have a hard time seeing that in one move. Maybe we need a little bit more of a rotation on the left-hand side before we move over. If we look at high yield, then we see a chart that is it looks slightly better, But look at the raw RS line here. That's still going down. And you can see that this RS ratio line hasn't even started to, I mean, it's leveling off, but the momentum is still negative. It's rising, but it's still negative. And that's positioning that tail for HYG still inside the lagging quadrant. And the difference between those commodity graphs and these bond complexes makes that I prefer the commodity charts a little bit more over the bond charts. When we then move to the dollar index, to the US dollar, we see that relative momentum has picked up. But look at the relative strength versus VBINX. That's the benchmark that we're using for this group of asset classes. And again, a very low reading of the RS ratio. That makes it very hard for the US dollar to immediately start outperforming the VBINX benchmark. And if you look at the chart here, I'm looking at this in terms of, could this be a double bottom ending this downtrend here? And that's a possibility, especially when we take out that 99.5. But then right here around 100, this is massive old support that will act as resistance. So before the US dollar becomes, or the dollar index really becomes a strong asset again, I think it needs to break above 100 and then start its way up. So for the time being, I'm still keeping the US dollar as an underperformer. It's way to the left-hand side on that graph. It's right here. And as you know, with this type of low reading, the odds for the US dollar to rotate from lagging to improving and then back to lagging are actually pretty high. So the US dollar, unfortunately, remains at an underperformance rating. We now have covered all these asset classes, and I will wrap it up in the end. I'll show you the painted picture, but for now we've got the bond complex all underperforming. We've got stocks outperforming very clearly. We've got commodities on improving, bit of a subjective call, but here we are. Same for crypto as weakening. Well, it just moved in there. Again, a little bit of a subjective call. And then cash, the dollar is an underperformer again. That's the big picture on asset classes. Now let's move to government bonds. Work from left to right. We start working on government bonds. And in order to do that, I need to load up, and it's in US markets, and it's the US bond maturities. And that gives you, love these RRGs. Look at this. This is a pretty clear picture. So just to be clear, what we have here are 6 ETFs that cover 6 segments on the yield curve from short to long. So you got BIL, which is 1 to 3 month. You got SHI, which is 1 to 3 year. IEI, 3 to 7 year. IEF, 7 to 10 years. TLH, 10 to 20. TLT, 20 years plus. The benchmark is GOVT, which is an aggregate of all these segments on the yield curve. And I think that this picture is speaking volumes. It's a very clear picture. So you got IEF, TLH, TLT clearly outperforming, and we've got IEI, SHI, and BIL all very clearly underperforming. That is very clearly a message that these are long-term bonds, so these are prices. So long-term bonds are going up, long-term yields moving lower, and short-term bonds are going down on a relative scale. And that means that short-term yields are going up. And that means that the yield curve right now is flattening a little bit. The 10-2 yield curve is positive right now, and it means that difference between the two is now slightly tilting and moving a little lower. Nothing dramatic, but there is very clearly now a preference for the longer end of the yield curve. We're not going to look at any charts to save some time. We looked at GOVT, and that should tell you the picture. So even though government bonds are underperforming the benchmark, if you have a portfolio in which you still want to keep an allocation to government bonds, I mean, the benchmark is 60-40, VBNX is 60% stocks, 40% bonds, then unless you're 100% stocks in your portfolio, but if you have a 20% allocation to bonds, which means that you're 20% underweight, which is pretty aggressive, you still need to put 20% of the portfolio into government bonds or into bonds. And in that case, the longer end of the curve would be the preferred area, even though the bigger picture is underperforming VBINX. So that's all about portfolio construction. And then let's move to the sectors. We look at the S&P 500 sectors. We know this image by now. And I'm going to do this really quickly, otherwise it'll become a very long video if I go over all these individual charts. But if I look at the positions on the RRG, and this is a weekly RRG, so it's kind of medium to longer term view. We have XLK far to the right, inside weakening, going through a bit of a correction, but still the leading sector. So that's definitely an outperformer. We have communication services on the right-hand side. It's the second strongest reading. Still a very strong reading, despite that little hook here, inside leading, above 100. Strong sector, outperformer. Consumer discretionary, inside the leading quadrant, despite the fact that it's rolling over, and that's kind of a negative. And I'm not super happy about it, especially also when you bring in the price chart of XLY. So I am labeling this as caution, as potentially weakening. We continue to the left-hand side. Industrials, that is definitely inside the lagging quadrant. That chart, that relative strength line is going down. That's an underperforming sector. And then here we have utilities. Utilities are improving very rapidly. If you follow the best 5 sectors articles that I'm writing, this is unrelated to that ranking system, by the way. Obviously, you will see you'll see similarities, but I am really doing this, observing the price chart and the RRG, and the best 5 sectors articles are purely mechanical. And what you see is that the utility sector is improving very rapidly. And it is the sector that is accelerating. Look at the difference between the nodes here over the last couple of weeks. And it's the sector that is closest to the 100 level of crossing over and accelerating. So this is an improving sector. And I think this has pretty good potential, especially also when you bring in the price chart for utilities. Financials, not at all. Inside the lagging quadrant, look at how short this tail is, underperformer. Materials, same story. Inside lagging, look at how short this tail is, a little bit of a hiccup, but no material move in favor of either of those sectors. So they remain underperformers. If we look at energy, that is a sector that is definitely also improving. Look at the length of that tail, that's improving. So that I have in my framework also labeled as improving. The same goes for real estate and also for healthcare. Look at how long this tail is and how rapidly it's moving to the right. And it's got the highest RS momentum reading of the entire universe. So these are sectors, XLRE, XLE, XLU, XLV, that are definitely rapidly improving. And then finally, we've got consumer staples, which is inside the lagging quadrant. But also, if you look at the price chart, it's kind of a disaster. It's not doing anything. It's picking up a bit of relative momentum, but that's about it. On the price chart, there is not much to gain either. And that leaves us with, I think it's a mixed picture, because you know that sometimes I look at the defensive, offensive rotation to see if I can find any thematic move that could make a call on the market as a whole. And right now that's difficult because utilities and healthcare, for example, are considered to be defensive sectors and they're moving up. So that would be a warning signal for the market as a whole. If I combine that with staples and communication services kind of rolling over, maybe even put in technology for a short-term dip, I could argue that this is some sort of a signal that the market needs a breather and a preference for especially utilities and healthcare, maybe also energy as more defensive sectors. But that doesn't really match with the position of consumer staples, which is probably the most defensive sector at all. And that is the weakest sector at the moment. So that makes it hard to use, at least at this point in time, to use the current sector rotation as a tool to make a call for the S&P 500. What I do see is two sectors that are definitely leading, and that's communication services and technology. And until that changes, or until these are really starting to improve, that's probably where we still need to be. And then we move to the last asset class that we dive into, and that's commodities. And we also have a predefined list for those here. Commodities, and these are various GSCI commodity indices, and we are comparing them to G and $GNX, and here are the names. So that's the GSCI commodity index, that's the all-encompassing, and that's broken down into those 5 groups: precious metals, industrial metals, livestock, energy, and agricultural. And if we plot that on the RRG, we actually get a pretty decent image. Very clearly, GPX, that's precious metals, leading the way for commodities. Gold, silver, of course. And then we've got GYX, that is industrial metals, following suit. They're still doing very well. They're outperforming. They're inside the leading quadrant. Strong momentum, strong RS ratio, a little bit of a loss of momentum, but that's not major yet. And then we've got GVX inside the weakening quadrant. That is livestock. That is still definitely a relative uptrend, but it's losing a bit of momentum. So because of the strong trend, also if you look at the price chart, we're keeping this as an outperformer. So GYX, GPX, and GVX are clear outperformers. We cannot say that of GKX, which is agriculture, and GJX. Ooh, these are tongue breakers. Both on the left-hand side. GJX, that's energy, very clearly still in a downtrend. That little hiccup of momentum is not meaningful enough yet. And then we see GKX, which is agricultural, which went through an improvement, but is now clearly rolling over and accelerating. Look at the distance of those nodes and starting to head down. So these are clear underperformance. So what that means for a portfolio is that if you want to make an allocation to commodities, now commodities are not part of the benchmark of VBINX. So commodities you can add to your portfolio if you feel that it would add value as a whole, but it's not part of the benchmark. So that means, by the way, that this is what we call an open universe, because not all of the, for asset classes, not all of the symbols in the group are represented inside the benchmark. So for commodities, if you want to make an allocation to commodities, I have it as kind of improving. So it's a little bit of a subjective position there. I would say you need to concentrate on the metals, on precious metals and industrial metals, and to a lesser degree to livestock, but stay away from energy and agricultural commodities. And that brings us to this picture. And you can see that now, after looking over all the RRGs, I have color-coded the various asset classes and the various members or securities in those asset classes. And you can see the underperformance for the bond complex, the strength of stocks, the improvement for commodities, the kind of weakness for crypto, and the underperformance for the dollar index. And then inside government bonds, clearly the preference is with the longer dated bonds. Inside stocks, we are definitely looking at communication services and technology, followed by utilities, healthcare, real estate, and energy, and stay away from materials, financials, industrials, and staples. And inside the commodity complex, the focus or the expectations are highest for both industrial metals and precious metals, and also for livestock. I've dated this chart, and I'm going to, the plan is on a regular basis to actually copy this image and then update it with a new date so we can see how things evolve over time. Let me know what you think of this approach. If you like it, if you don't like it, if you have comments, if you've got improvements, if you've got good ideas, always open to listen to that and talk to you in the comments under the video. Thank you for watching, and I'm looking forward to seeing you again soon at a new RRG video here on Stockcharts Television.